I think the stock market's making record highs. Cryptos and Bitcoin should make record highs. They're completely highly correlated. What's kind of discombobulating this year is that gold's doing it too. So I think gold's a more significant indicator. And yes, it hasn't really mattered yet. Cryptos are in a tear. That's fine. That's wonderful.
Another true bear market for most altcoins. I'm not saying Bitcoin will do that, but most altcoins will fully have brutal bear markets.
Bitcoin was part of this massive America Great rally, and that's what I'm worried about. Sparks that might kick that lower. And so far, the only thing so far is really gold. But if inflation's a problem, then that 10-year note yield that bumped kind of bottom around 4%. The high for the year is around 4.70 or so. It should go up, and that's the number one thing that matters for 10-year note yields. And it's not, and partly because we're seeing pretty significant deflation in the rest of the world, and most notably China.
Markets always look their strongest just before the cracks begin to show. That's the warning coming from Gareth Soloway, McGlone and Scott Melker, 3 traders who've spent decades studying cycles, bubbles, and breakdowns. Their message is blunt. Don't assume Bitcoin is immune if the broader US market stumbles. They argue Bitcoin's rally hasn't been entirely organic. It was part of the wider surge in risk assets. If that tide goes out, Bitcoin could fall with it. Some even suggest a scenario where it retraces to levels as low as $10,000. That sounds extreme, but history is full of deep crypto drawdowns. The difference this time is that such a collapse would probably coincide with an economic shock worse than 2008, maybe even something resembling the 1930s depression. In that kind of wipeout, altcoins wouldn't just slide. They'd get obliterated. The trio highlights a key historical pattern. Whenever the Federal Reserve has shifted from tightening to easing, the winners weren't stocks, but gold. In 2001, 2007, and 2019, cutting cycles favored hard money over equities. They see the same script starting to play out now. On the surface, the U.S. economy still looks steady, and politics remain in their usual tug-of-war between parties. But under the hood, stress is building. Over the next year, traders should brace for turbulence, because if history rhymes again, the shift could be brutal. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The tariffs on a scale of 1 to 10 are probably a 2 compared to this. And this is the number one thing that matters for inflation. Scott just touched on it. This is the U.S. stock market cap to GDP. I just take the S&P 500 divided by GDP. It's pretty close, 2.2. It's actually 2.3. We're the highest in the 100 years. That's a significant wealth effect, inflationary force. And when that goes down, I didn't say if. Now, the thing is it can continue higher forever, right? When that goes down, that's normal deflation from inflation. This is what I'm worried about. This is, I just take the same thing, S&P 500 in terms of gold. It's turning down. And this is the same level as at first. It's flatline versus gold since 1997. So imagine that. We've gone through the whole internet bubble. We've gone through this whole AI bubble. And if you're a holder of gold and a holder of S&P 500 and getting this is a total return, by the way. This is why I show you. A long term, I want to show you. Long term, stocks always beat the rock long term. But now we're pushing 28 years or so where they're not doing it. This is what I'm worried about and throwing over. And here's Bitcoin. It's just, this is why I'm saying when it does have a correction, it can easily go back to 10,000 and mean nothing. Bitcoin was part of this massive America Great rally, and that's what I'm worried about. Sparks that might kick that lower. And so far, the only thing so far is really gold. But if inflation's a problem, then that 10-year note yield that bumped kind of bottom around 4%. The high for the year is around 4.70 or so. It should go up, and that's the number one thing that matters for 10-year note yields. And it's not, and partly because we're seeing pretty significant deflation in the rest of the world, and most notably China.
Bitcoin's not going to $10,000. I don't know. So I can't. I know that Mike deeply believes in it. I just yes. I mean, if Bitcoin was $10,000, then I don't even know where I'm getting my drinking water.
So that's a very profound statement, because I made the same call in 2018 and I got 70% of the call. I said it loses zero and went from 10,000 to 3,000. But that's the key point now. It's so inconceivable for that. So I am making the call. I've been to her that we're overdue for another 50% drawdown in the S&P 500. And I need to show you how that stuff happens. This is just a chart of gold divided by S&P 500 ounces of gold. When the Fed started easing in 2001, you wanted to be short the S&P 500 long gold. It just collapsed. Again, same thing. Fed started easing September 2007, same thing. You wanted to be short the S&P 500 long gold. Even when we started easing here a little bit in 2019, now we're starting to ease and it's just starting to roll over. Hopefully it's different this time. Hopefully McGlone's wrong. I just pointed out gold seems to be maybe we'll get through the rest of the year, it's fine. That's why I'm worried about this next 3 months will just be pretty significant. Let's put it this way: we cannot.
That's so far. That would just be like 10,000. It's like a bigger drawdown than the most volatile early days with Mount Gox. It would be so bad.
Well, I think so the idea would have to be a worse situation than 08, 09, right? I mean, for essentially you're talking about
it would have to be a double. It would have to be worse than 1930. And that it could be. I'm just saying.
And you're right.
The situation if it's you would have to have for Bitcoin 10,000. You would have to be
drinking water from.
Yeah, you would have to be in a deep, deep Great Depression for Bitcoin. Another true bear market for most altcoins. I'm not saying Bitcoin will do that, but most altcoins will fully have brutal bear markets.
In terms of history, it's much less of an if. It's the wonderful check and balance of the U.S. system. I mean, that's the key thing about, we got rid of Biden, and we got a president who's very crypto friendly. Okay, great. I mean, the populists did that, done with it. And at some point, it's going to get pissed off and sick of this guy or his policies and tilt the other way. This self-correcting mechanism in our country is awesome. And the midterms almost always flip back. So it's very likely, depends. Now, right now, everything's fine. But we start getting a little more, people are not really appreciating these type of comments that, if you criticize him, you get pressured. That's not the American way. It's just, sorry, that's what made us great. But it's just, I'm sensing that, everything's great right now. Equity, stock market, unemployment. But there's a lot of wood to chop before we get to those midterms.
The Fed has started cutting rates, but the reaction isn't playing out the way they'd like. Instead of easing financial conditions, long-term yields are actually rising, putting pressure on mortgages, corporate debt, and auto loans. On the surface, the economy looks steady, which makes these cuts harder to justify. Yet markets don't care. Investors have convinced themselves that rate cuts automatically translate into higher stock prices, and they're pouring into risk assets as if it's a guarantee. Mike McGlone warns that this belief is built on shaky ground. History tells a very different story. In 2001 and again in 2007, the Fed shifted from hiking to cutting, and stocks didn't soar. They collapsed by 45 to 55%. Rate cuts are rarely a bullish signal. More often, they confirm that underlying problems are already at work. For now, volatility remains low, bonds have staged a rebound, and gold has already had a strong run, leaving it vulnerable to some short-term profit-taking. But the deeper risk lies in equities. Stocks are priced at extreme valuations, disconnected from economic reality. Government officials and major institutions are doing everything possible to prop them up. Policy tweaks, announcements, PR spin, but history suggests that kind of balancing act doesn't last forever. Let's get back to the interview.
I think he is stuck in the middle. I think there's a lot of just excessive analysis of, okay, they cut rates. They started cutting rates. There's, I guess, dicey reasons to do that. I love how it's kind of stuck in between. And the day after he cuts rates, unemployment claims collapse. Like, oops. And right now we see bond yields going up. That's not what they want to happen. But either way, the bottom line I take from is what we discussed last time. Fed funds futures in 1 year, so 3% Fed funds. So death taxes and 3% Fed funds. I mean, this is just a guarantee that's going to happen. And what takes us to not go from there and not get there? So what's happening so far is the narrative that everybody seems to agree with, that yes, the Fed's cutting rates, stock market goes up. But I really enjoyed pointing out the facts of those of us who made some good money back in 2002 and in 2007 to 2009, just by Fed started cutting rates. And the day they started cutting rates in 2007, after that, the S&P 500 dropped 55%. The days they started cutting rates in 2001, the S&P 500 dropped 45%. So just let's be careful with those. People have to be careful with those false statistical narratives. But as far as what's happening is, I'll put it in one headline. I see it on the terminal right now, and that is, Trump threatens to axe licenses of TV stations that criticize him. So part of the reason they cut rates is because of a little bit of pressure. And every time I see that, I think of one thing, and I think the gold market just smiles. You see these kind of things. But overall, the macro is, the economy is fine. The Fed's cutting rates. The number one thing, the only thing that really matters is U.S. stock market. It's got to keep going up. And right now it's fine. Everything looks great. The Bloomberg 20-plus year index, it's a bond index. It's up 6%. That's a treasury bond index. I've been wrong on, but I think, gold needs some profit taking. The stock market, well, maybe never will get some profit taking, but it's still, volatility is still very low. VIX is running 15%, and Now what do we do? Does this just keep marching on?
I mean, I think we got exactly what we expected from him, right? Which was we're going to get cut now. What do you call it? A risk management cut. I mean, he basically was non-committal on future cuts, even though we know what the expectation is. He admitted that inflation is ticking up while cutting, which is basically saying hello stagflation, and hinted to the fact that he's cutting because of the bond market. I mean, because of the job market, right? So like you said, there's no good decision for him. I agree that he looked beaten down. That said, I think we're just in one of those irrational places where people are expecting everything to go up and keep buying. Yeah, I really think it's very heavily risk on because people had built in their mind, all we need is rate cuts. All we need is rate cuts. We're going to get more rate cuts. They didn't really listen to him, and they're getting what they wanted. It's the self-fulfilling prophecy of the expectation of more liquidity. It just seems like the government, as you said, is extremely and deeply involved right now in M&A space, in the manipulation of the market. It's pretty crazy, but they have a lot of levers to pull to keep this thing going up, as you can see.
And I think that's what I'm gathering from this is that there's always an announcement behind potentially something that could be negative. So, okay, so maybe the economic data is negative. Well, let's put out this PR right after the bell about this positive thing, and it's essentially helping keep the market and keep it pushing up. But Mike, you've been around long enough. How long can that last?
It's not going to end well. I find it very disconcerting. I think that's, like I said, like gold is figuring it out. It's the key thing I like to look at is like the macro big picture to get through 4 years of this without, the stock market most expensive in history, without a normal 20% correction that stays down for a year or so. I think it's very unusual. Now, we've had the little 19% boom that popped up, quickest recover ever. So that's why I think what's happening in the macro. And I can show a few charts that I'm looking at if my connection is okay, because I had to shut down a few things. I'm in the London office this week. And if you can share, I want to show real quick the thing we talked about last week. So this is MicroStrategy. It dropped. To me, this is the pinnacle of risk assets. It dropped below its 200-day moving average. The 200-day moving average is rolled over. It was supposed to be a buy. If you bought it, it's bouncing. Can it hold that 200-day moving average? So this is the pinnacle of all risk assets, I think, is represented by MicroStrategy. And those of us who really jumped on and agreed with Michael Saylor back in 2020 said, yeah, exactly. The market's supposed to go up from those levels. Risk assets, obviously Bitcoin. And this is the epitome of risk off assets in deflation. It's the U.S. Treasury long bond. This is a treasury. This is where I started in the trading pits. It's a market I thought I knew better than anything. I never thought it'd go down this much. And it popped up against the 200-day moving average. And now it's potentially rolling over. I don't think it is. I think these are potential crocodile jaws that are going to narrow. That's a short term. Let me just show you some really big picture crocodile jaws that I'm concerned about. And this is, you just take, again, here we go, S&P 500 in terms of GDP, well, just the stock market GDP, 2.3 times, the highest ever. Okay, 100 years. And then I was able to find a Go database. I went back, 40 years to compare the treasury bonds to gold. And you got to go back to 1983, last time treasury bonds were this cheap to gold. So I look at stuff like this. I'm like, okay, where's the value here? That's why I'm still bullish gold, still bullish bonds, not bullish risk assets, most notably cryptos. I'm looking for that, and it hasn't happened yet. So what's that going to be? So I'm wondering if that's going to happen. I'm thinking the 3Q is the time for that, but obviously it's not happening in the short term.
Market optimism has a way of peaking right before reality turns. What we're seeing now is a dangerous cocktail. Stocks trading at levels divorced from fundamentals, investors convinced that central banks can cushion every stumble, and a wave of capital chasing risk as if history doesn't matter. That kind of confidence often precedes the harshest corrections. Rate cuts, in particular, are widely treated as lifelines, yet history shows they more often confirm that damage is already spreading beneath the surface. The collapses of 2001 and 2008 didn't begin with hikes. They deepened after the easing began. Gold tends to thrive when those cracks widen, acting as a store of trust when other markets lose theirs. Bitcoin, on the other hand, while built on the promise of independence, has shown a pattern of rising and falling with the same tide that drives equities. That doesn't mean it has no future, but it does mean its fate isn't sealed by narrative alone. it's still tied to the same liquidity cycles and investor psychology as the broader market. Altcoins, even more fragile, would likely feel the full force of a serious unwinding. Right now, bonds have shown hints of recovery, volatility remains surprisingly muted, and officials are doing everything possible to hold the line. But you don't need to look far to see the pressure points: higher borrowing costs, overstretched valuations, and a public condition to believe that policy fixes will always buy more time. History suggests that faith is misplaced. The real question is whether the next shift delivers just another market dip, or if it sets the stage for a reset that forces investors to rethink where safety truly lies. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.